What if I told you that a company losing 10,000 million a year just raised another 20,000 million? No profits, no real plan to be profitable, but still, investors are throwing money like a confetti at a wedding. Welcome to Indian Startup Land, where burning cash is the business strategy and growth at all costs is the golden rule. Why are companies that lose money faster than they earn it still get funded? This isn't a story about a startup. It's about hype, psychology, and broken incentives, and a system that rewards spending more than sustainability. So let's start at the beginning.
EdTech startup BYJU'S is laying off around 2,500 employees, which is almost 5% of its workforce.
According to Bloomberg, the Registrar of Companies in Hyderabad has been tasked with probing discrepancies in BYJU'S financial statements.
Another setback for BYJU'S. In less than a week, NCLT's Bengaluru bench has refused to allow closure of insolvency proceedings despite a settlement proposal.
US lenders raising allegations of siphoning off, of mismanagement, saying that their claims are still outstanding and therefore there can be no case made out for closure of these proceedings.
Back in 2015, something changed. Flipkart was exploding. Ola was challenging Uber. Paytm was becoming a fintech giant. Global investors saw one thing: 1.4 billion people hungry for digital service. So they called it Indian Startup Decade, and they were ready to pour billions into next big thing. And so began the gold rush. Suddenly, raising capital became a badge of honor. Every another day, startup raised Series A, B, C, and even sometimes E. Valuation skyrocket and revenue? Well, we figured that out later. The formula was simple: raise money, burn fast, and grow faster. You would get 500 crore and spend 400 crores on discounts, influencers, marketing, and expansion. Lose money on every customer but gain millions of users. And investors, they weren't worried because your graph showed growth, and growth sales. So even if your unit economics made no sense, your story did. And when your story is convincing, money keeps flowing. So you may wonder, why would smart investors fall for this? Well, they are not betting on profitability. They are betting on monopoly. Because if one startup can capture the market, crush competition, and become the default app for everything, then someday, just someday, they could flip the switch, cut costs, raise prices, and finally turn profitable. But most startups never reach that switch. Take BYJU'S, the shiny Indian edtech boom. At its peak, valued at 22 billions, acquiring companies like Akash, Whitehead Jr., Epic, and trying to own the entire education stack. But under the surface, a financial mess. Delayed reports, massive layoffs, allegations, and a brand that's gone from billion-dollar darling to a cautionary tale. The burn rate was insane, but the funding didn't stop until the truth caught up. And by then, it wasn't just BYJU'S that paid the price. It was teachers, employees, parents, and vendors. You see, in a startup game, when the illusion breaks, everyone bleeds. But let's be fair, BYJU'S isn't alone. Zepto, Dunzo, Grofers, BharatPe all burned through billions chasing growth. Some still do. And again, the logic is the same. If we grow fast enough, eventually we become profitable. But in most cases, that eventually never comes. So why does this keep happening? Because in venture capital, you just need one Flipkart to justify 100 failures. VCs aren't looking for steady businesses. They are looking for unicorns. And if one startup hits big, the fund wins. But here's the twist. What happens when the whole ecosystem becomes obsessed with growth and forgets how to build a business. You get companies with 1000 crore in losses, 10 crores in revenue, and 10,000 crore in valuation. You get inflated metric, fake GMVs, burn without breaks, and slowly you stop solving the real problem and start chasing investor statement. And that is when a bubble becomes to form. And that bubble don't announce themselves. They seduce you with headlines, with funding rounds, and billion-dollar valuation. And by the time you realize it's a bubble, it's already popped. Now, this isn't just an Indian phenomena. America had WeWork, Theranos, FTX. Every market gets carried away. The question is, will India learn faster? Some startups are. Look at Zerodha, bootstrapped, profitable, never raised a dime. Look at Zoho, over 1 billion in revenue, no outside funding. Even credit is shifting towards monetization now. We are slowly seeing the pendulum swinging back from funding obsession to business fundamental. And that's a good sign. Because the future of Indian startups shouldn't be about how much you raise. It should be about how much value you create. So, here's a takeaway. If you are a founder, build to last and not just to raise. If you are an investor, look beyond vanity metric. And if you're just a curious observer, ask more questions. Because the next time you hear about a startup raising $1 billion, ask this: are they building a business or just burning for the next round? Thanks for watching. If this video gave you a new perspective, hit that like button, subscribe for more deep dives in tech, startup and money, and drop a comment below which Indian startup do you think is building the right way. I am Deepak and I will see you in the next one. Bye-bye.